Ladies and gentlemen, this is Barry Norman, and welcome to our class on support and resistance, which is a really important concept that everybody needs to master. Now, tonight's class is brought to you by TradeTime. That's www.tradetime.com, one of the most unique trading platforms in the Forex CFD arena. They allow you to set up an account that is defined by your goals, your personality, and what you want and what you need. And you can change it anytime, but then it's all set up to fit your particular personality. And it is a very unique offering. That way, the emails, the signals, the whatever you want fits the assets you would like to trade, fits the type. If you're a beginning, you're a novice, you're an advanced trader, whether your personality is a shark and very aggressive, everything will be formulated to fit what you are looking for and what you need. They offer a wide variety of trading tools, everything from market summaries right on the platform to up-to-the-minute technical analysis, as well as news and market trends right on the trading platform. They also give you one of the most advanced platforms with fast execution, and you can customize your alerts and anything else you need. They have advanced charts, technical indicators, and very, very fast execution. Plus, they're constantly pushing out to you signals, and they're not only telling you what asset should be traded and what's hot and what's not. You can also see where to put your stop loss, where to put your first objective and your second objective, which direction, and you can see how many traders on the platform have actually traded from that signal. So you can make a better decision. So give TradeTime an opportunity. You can set up a customized trading platform without any credit cards and get a demo account and try it out. Take a romp through everything they offer and then decide, or just use their charts, get their signals, whatever you want to do. So go to www.tradetime.com and try out this very unique way of trading in the Forex and CFD arena. Now, tonight's class on support and resistance is being recorded. You can access a copy of the recorded version of the class in about 24 hours after the class is over by going to www.investing.com, where you signed up for the class. Look for the education tab, and then look for webinars on demand. And you will see not only this webinar, you'll see all of the webinars we've offered over the last few years, and they're all broken down and easy to find. And you can watch any of them or all of them or see this one at your convenience. Now, tonight we're going to be discussing this very important concept, and that is support and resistance. And it's a fairly simple concept. When discussing it in the context of the stock market, the Forex market, the commodities market, or even the cryptocurrency market, it defines the levels at which buyers and sellers step into the market, or where the law of supply and demand comes into play. Imbalances in supply and demand create support and resistance levels. For example, when an overwhelmingly high number of buyers or demand step into the market, an indication of support is being put into the market. Conversely, a large number of sellers indicates that there is an overhead resistance preventing that asset from moving higher. Okay, that sounds a wee bit complicated, and it is, that explanation. But support and resistance are very easy to understand. Imagine that price moves like an elevator. The floor below your feet is your support. The ceiling above your head is your resistance. So when that elevator wants to move up, you need to break through that ceiling to reach the next floor. And what happens, that previous ceiling becomes your support level holding you up, and you have to break above the next ceiling. And if the elevator is coming down, it just becomes the reverse. So support is what's holding you up. Resistance is the price you're having to break through to get any higher. So as you jump up to that ceiling and try to break through it, you're going to fall back down. And where do you fall back down to? That support level on the floor. You bounce up, and each time you bounce up, you break that ceiling a little bit till eventually you push through that ceiling, or the reverse. Now, there are many ways to secure these levels of support and resistance. but it's not difficult. Okay. So imagine once again, like I said, like you're in an elevator. Now, if I were to say that you are gold, and I were to paint gold across your chest and say you were at $1,000 and push you into an elevator, and the doors are closed, you're gold. You don't have any hands, so you can't push the buttons. Now, as the elevator is moving up, the floor keeps pushing you through to those resistance levels. But you don't know where that elevator is going to stop. So you're not exactly sure what that ceiling above your head is, what level it's at. Now, if you had done some proper evaluation before I pushed you into this elevator, and you knew you were in, say, a 5-story building. On the ground level of that building, it had lots of retail stores, a coffee shop, and stuff. And then the next 4 levels, the next 2 levels were offices. The 1 level above that was conference rooms. The next level above that was the roof deck where they had smoking section. They had lunch tables out where people could go sit. There was vending machines. And then, of course, there was a basement. Now, if you had sat down and done some evaluation of how the price moves in this range, you might say, okay, well, we know between the hours of 9 o'clock and 6 o'clock, there's going to be lots of traffic to the levels 2 and 3 or 1 and 2 where there's office buildings. We know at 3 o'clock today, there is a big conference scheduled in the conference room on the 3rd floor. So we also know the janitor cleans the building in the morning, and during the rest of the day, he's out doing repairs, and they're emptying trash cans here and there. But early in the morning, he takes the elevator to the 1st floor, cleans the 1st floor, gets back on, goes to the 2nd floor. So at 6 and 7 o'clock in the morning, when that elevator is moving up, most likely it's just going to move up to the 1st floor, and when it's finished, moves from the 1st floor, it's probably going to move to the 2nd because it's just the janitor in the building. So you've done some market evaluation. Lunchtime, there's most likely I'll be in lots of traffic on that elevator going to the roof because, like I said, they have vending machines, coffee machines. They have tables and chairs where the employees who are working in those offices can go sit and have lunch. And, during the day, also there's going to be a lot of traffic to that roof because that's where smoking is. So you can judge that anytime that elevator is on the 1st, 2nd floor and going up, it's most likely to go up to that roof. Okay, because there's no conference until 3 o'clock. It could stop at that conference floor because somebody's setting up for the conference, but the probability is it's going to go up to the roof. So what have you done? You can't push the button on the elevator, so you're just standing there as it moves up and down. But you've made some very important assertions. You've gotten some knowledge. So you can then start evaluating if this price is moving up, where it should go to, and statistically where it should go. And if it goes through the 2nd floor, okay, it's 11 o'clock in the morning. There's nothing really in the conference room. So most likely it's going to go to the roof, which is your next resistance level because it's not going to go through higher than the roof. So you can determine these fairly easily. Now support. Now, breaking these apart is not that difficult. If you can just understand the ceiling and the floor of an elevator, and they're the opposite moving up and down, support is the price level at which demand is thought to be enough to prevent the price from declining any farther. The logic dictates that the price declines towards support and gets cheaper. When it gets to a certain level of getting cheaper, buyers will re-enter the market buying, pushing the price back up. So imagine you had buyers buying the euro. They bought the euro 120, 121, 122. They pushed it up to 123. The buying ended. There's no more buyers, and the price started easing down. Okay, it's most likely to ease down because those buyers are looking to re-enter the market. They want to come back and buy because they do believe the price will continue up, but they want to enter the market at the lower price. So as the price ticks down from 123 to 122 to 121, at some given point, which is most likely the next support level, that it got support moving up, the buyers will start re-entering the market, pushing that price back up. So support does not always hold, and a break below support signals the bears have won out over the bulls. A decline below support indicates a new willingness to sell or the lack of incentive to buy. Support levels are usually below the current price, but it's not uncommon for a security to trade at or near a support level. Technical analysis is not an exact science, and it is sometimes difficult to set exact support levels. In addition, price movements can be volatile and dip below support briefly. Sometimes it does not seem logical to consider a support level broken if the price just closes an eighth of a pip or an eighth of a point below its established price level. For this reason, some traders and investors establish support zones. So imagine we could say, okay, if the elevator is moving from the ground level and it's about 9 o'clock in the morning, we know it's mostly employees coming to work because 9 o'clock is work time. So we know that elevator is most likely to stop between the first floor and the second floor, depending on which office you're going to. So you can say we have a support level at, well, since the elevator is moving up, it's a resistance level between 1 and 2, because you're not sure if it's going to go to 1 or 2, where it's going to stop. So you can say, this is my resistance level. So you're not sure if it's going to go to 1 or 2, but if it breaks that resistance level and continues moving up, that 1 and 2 became your support level. So when it comes back down, it's most likely to stop running, and it's going to then start moving above that support level to its next resistance level. Okay. So the resistance level is the price at which selling is thought to be strong enough to prevent the price from rising farther. And the logic dictates that as price advances towards resistance, sellers become more inclined to sell and buyers become less inclined to buy. By the time the price reaches the resistance level, it is believed that supply will overcome demand and prevent the price from rising any farther. Now, if you stop and think, okay, I've looked at this building and I've determined the floors above and below and what floors are crucial numbers. And then I add something called simply volume in there. That's how many people are stepping on the elevator. Okay, so it's 9 o'clock in the morning and that elevator is full because everybody's coming to work. Well, you're sitting there, you can see that. You see the volume has gone up. Well, what are the chances statistically of that elevator stopping on 1 and then 2? Well, that's very high probabilities because the elevator is full. There's lots of volume. But as you move through 2 and you get up 2 and everybody's off that elevator, everybody got off from 1 and 2. What are the probabilities that that elevator will continue up to 3 or to the roof deck because everybody just came to work, or it's going to go back down to the ground level because lots of people are still coming back to work, so everybody's pushing and is going back down to pick up the next load. Okay, so volume becomes an important determination to help you determine how price should act at these support and resistance levels. So resistance levels are usually above the current price, but it's not uncommon for a security to trade at or near resistance. Now, support equals resistance. Now, as I tried to explain to you, is that as price moves through, or the elevator moves above and below these floors, the resistance flips to the price. So here the elevator moved up and came to that first floor, came back down to that ground level. So this was its resistance here. This was its support level. Moved back up and stop for a second at that resistance level, okay, and broke right through it and continued up. What it did is it came up straight up to the roof. So this level right here, which was the resistance level at this point, now is the support level, because when the price is easing back down, we'd expect it to come to that support level. So another principle of technical analysis stipulates that support can turn into resistance and vice versa. Once the price breaks below a support line, the broken support level can turn into resistance. The break of support signals that forces of supply have overcome the forces of demand. Therefore, if the price returns to this level, there is likely to be an increase in supply and hence resistance. Now, once we've determined these support and resistance levels, okay, we can then make intelligent trading decisions. We could determine what we want to enter the market. So in other words, if we were looking at this asset on this little chart here, okay, and we saw a price moving up to the support level, okay, and bouncing off of that support level, we might want to sell into that asset because it wasn't able to move any stronger. So we know the forces of and resistance is working. When it moved up here and broke this resistance level and moved up, we might want to enter a buy position above. Or if we had already determined we want to buy this asset, we might want to place an order to execute a buy when price breaks above the support level. Okay. Or if we want to determine where our stop losses should be, where do we want, if price is moving down, okay, this way, and then moving up, we need to determine where we're going to put our stop loss. So our stop loss could have been at the next resistance level or back at that ceiling floor, and we could have entered a buy point, a take profit point at the next resistance level, and we could set it a wee little bit below to see if it breaks through that resistance level. So there's many ways to use support and resistance to make selling and buying or trading decisions. Now, the other great way is you can see in this asset here, in the NASDAQ 100, as price bounced off of the support level and moved up to the resistance level, fell back down to support, moved back to resistance, fell down to support. Now, historically, the more times that prices function between the support and resistance levels, the more time it's hit it, the more valid it is. So here we can see when price fell below, at this point, broke below the support level, okay, and moved back up, it bounced off of there. Okay. So now that tells us the price is most likely going to continue down. Here it came back up there, bounced off of it, and came back down. Here it finally broke through. But where did it move? It stayed. It never was able to break above its roof level, say. Okay. So you could have been trading this asset by selling it every time it hit that resistance level and buying it every time it hit the support level, because those levels of support and resistance have been validated by how many times that price reacted to that. So the first thing we want to do when using support and resistance levels is to watch for breakouts. As we noted, price can and does cross their support and resistance level on the way to forming new trend lines. Use the current level as a guide, but realize they will change over time. Think of changes as opportunities to make profit. Now, tip 2 is when charting the price action of an asset, expect to see at least 2 price bounces before considering a given high or low to be a new support or resistance level. Preferably, you want to see 3 bounces since each one strengthens the signal. 3, asset prices tend to test support and resistance levels without breaking through them. You'll likely become nervous when this happens. It's normal. Calm your nerves, learn to trust your charts. When a breakout occurs, it usually does so in the context of forming a new price trend. Your chart should give you the heads up about that in advance. Now, 4, don't get lazy with your charts. The more you trade a particular asset, the more you'll feel as if you know how its price will move. Be warned that, especially in binary options, have a way of surprising even the most experienced traders. Intuition is important, but tracking price action, keeping accurate charts, and collecting reliable data are much more so. If any of these concepts seem complex and confusing, don't worry. With time, you'll find that they are actually simple to understand and apply. Most of the complexity is due to a lack of familiarity. Now, resistance is not just some random area where price turns around. There are potential sellers, traders who have sold a Forex currency pair once before and remember the collective power that they had to push price lower. There are also buyers who went long at support and were disappointed that price did not go higher and will close their buy positions. So imagine the euro's moving up, okay? 120, 121, and I'm using big whole round numbers. I'm not going to go to 121, 240 because I can't even remember the number. So it's moving up 121, 122. You bought the euro at 122 with expecting it to go to 124. And that's a huge move, but just for talking's sake. So you put your take profit point right above 124. Anytime it bounces above 124, you're happy to close out your trade, take your profit. You put your stop loss back down at 121. Now, if price is moving up and it crosses this 124 level, it triggers lots of people sell because they're selling to take their profit. So what happens when lots of people sell and close out their trades, because they're all done automatically, the price will ease back down because they have to fill all of those sell orders to buy. As price is falling down, trading against them, and it falls down to that 121, it triggers lots of people's stop losses, who then close their position by buying that asset. And it bounces off that resistance level and moves up. So it's almost sometimes a self-fulfilling prophecy. Now, another group that makes up resistance are the ones that bought at or near resistance and are trapped when price fell at resistance. These traders are begging for price to come up one more time to get out at a break even. All of these groups work together to send prices lower and make up the supply in the supply and demand equation. More supply than demand, price falls. More demand than supply, price rises. Okay. So in the chart here on the pound, we've drawn on our support levels and our resistance levels, and you can see every time it's moving in an uptrend. Now remember, you only want to trade with the trend. So we see price moving in an uptrend. Okay. It's really supporting the trend line here, and every time it falls back down to its support level, it's you would buy and maintain in that position at each time. And each time it hit a new support level along that trend line, you would then buy. So once you've established these support lines, and these support lines are established in many ways, and we're going to talk about those in a second, how you would get these levels of support. Because there are many different ways. There's what I use to call eyeballing. Then there's pivot points, there's Fibonacci levels. Okay, and the more of these you combine together, the more accurate or the more defined you're going to have of these support levels. So eyeballing is my favorite. And back, if you're a chartist, okay, and before computerized stuff, we had to go look in old charts and draw lines for, and what you're looking for is when this asset traded near at or at the price it's currently trading, historically, what did traders do and what price points were significant in the prior trading around that asset? Now, each security has its own characteristics and analysis should reflect the intricacies of the security. Sometimes exact support and resistance levels are best, and sometimes zones are better. Generally, the tighter the range, the more exact the level. Now, the key is the identification of key support is an essential ingredient to successful technical analysis. Even though it is sometimes difficult to establish exact support and resistance levels, being aware of their existence and location can greatly enhance analysis and forecasting abilities. If a security is approaching an important support level, it can serve as an alert to be ever extra vigilant in looking for signs of increased buying pressure or a potential reversal. If a security is approaching a resistance level, it can act as the opposite. So what we want to do is we want to look on a chart. We want to look back, and it's a great way to do it. You find support and resistance levels by looking for swing highs and swing lows. Okay. I look myself for opens and closes at about the same price. So let's go look. Now, it's a manually intensive process, but it also is, the more intensive it is, the more you've done manually by looking at a chart, the more you've understand this asset, because you're working on charts. You're not just looking at some numbers that were calculated and pushed out to you. So let's go to a live chart, and let me pop it up on your screen. Okay, so let's look at some chart, my basic chart here. So we're looking at the euro. This is a live chart, and we see the euro is currently trading right here at 119.25. Now we can see that this number where it is right now is a very crucial number, because look at how many times in the past couple hours that price has hit that level and not been able to move up above it. So that formed a support level. But we want to look at how important that level is. So if we just go back and look for when this asset was trading near or about this price. So we can see here it was trading above, but slightly above that price. And we can then look for either swing highs or swing lows or closes and opens that were strategically important by just simply drawing a line. Okay. There's no exact number. Okay. But to me, we're only seeing one area, and that's a more recent area that price was trading at this level. So we want to go back a little bit farther. We want to see when the euro was at this level before. So we'll just simply change our chart to a longer period of time and look to see if we can find something. Now we can see here, okay, some crucial price levels. Okay, we see lots of opens and closes at this price, but we see a swing high here that was crucially important. And if we were to draw a line, from that swing high to this swing high, okay, that could give us a resistance level if price was moving up. If we look slightly below that price, we can find a very crucial price point here. Okay, look at this. If we just draw, and you can move these lines, you can pull them. Okay, but if we even see, look at all the opens and closes, the highs right here at all. Let me get my marker on here. That how many times the price hit this high and wasn't able to break through. When it was moving down, we had a couple closes, we had a swing low here. When it was moving up, look at all the closes we had at that price. So we could say 118,749 is a crucial support level for this price. We can say that 119,264 is a crucial resistance level for this price. And we can set many of them. We can keep narrowing it in and narrowing it in. We can keep going back in history, or we can use other techniques. Okay. The more defined, because you can say and you can determine how important. You can color code them that like this is a key support level, and this is a minor support, or you can decide to make a zone. Okay, but right now, so we might want to go back to a little longer period and see if we have other prices. But we can see here that the euro hasn't really been at this high where it is right now for quite some time. So we don't have anything back, from last year at this price level. But we can again see important prices on this chart. Okay, and look at that, our support and resistance level, even on this chart, stay fairly important to that price. We see all of these tops here. We see this reversal here. So we can say that we've got a fairly accurate support and resistance level on there. So we're going to go back to our 1 hour chart because we're trading in short term. And we're going to use those, but we're going to say we want some more information. We're not going to just go with these eyeball numbers. They give us some start, but there's a pretty big gap between 119,348 and 118,74, and a pretty big gap above. So we can go to what we call pivot point chart. A pivot point chart is a mathematical calculation. Now, you don't have to calculate it. Okay? Any technical analysis site will pre-calculate them for you. Okay, and you're going to find these on what's called a pivot point chart, and they will give you the support and resistance levels 3 levels above and 3 levels below the current price. Now you have to make sure you're looking at the price in the current same as the chart at time. So we're looking at 1 hour chart. We want to make sure this is 1 hour. And so we can see the next support and resistance levels. And I'm not going to draw all 3 of these on here because we don't have the time, but we're going to take S1 and R1. So we're going to take 119.26 and we're going to take 119.37. And those are fairly tight numbers here. And we're going to go put those on our charts. So we're going to simply go on here and we're going to do another line. And we're going to make this one in red. And we're going to put this at 119.26. And then we're going to take 119.37 and we're going to do another red line. So we're going to go to 119.37 and put that on our chart. So now we have a support and resistance level directly above and below the price. Then we have our one step out with eyeballing. Okay. And we can keep adding these on and delineate these. So this is a very short term, very tight support and resistance level. And we have a longer support and resistance level. So we might want to say if the euro bounces back up and continues up or starts falling down, we would want to take profit here and put our stop loss here at the other resistance support level, and we might want to use the shorter term or the pivot points for making our entry and exit points. You can use all different types of support and resistance level. This is where you come to Fibonacci levels or Fibonacci retracements, and we can put these on a chart also by finding the swing low or the prior move up here and dragging that to the swing high. And now we have our retracement levels on our chart, and we can combine those together with more, because all we're getting is these are all support and resistance levels. And the more different support and resistance levels you get, the more you're defining, but all you're trying to do is define the price ranges above and below the current price and one step out so that you can watch the movement of that asset. So you can delineate this in many different ways to make it part of your decision making or part of your trading strategy. So let's go back to my PowerPoint for a minute here. And let's talk about ways we can use these. Oops, sorry, it tells me my screen went to sleep. Let's try this again. Okay, there we go. So we looked at live charts. Now here is an older chart on the USD JPY. So we were able to visually develop a level right here, because we look at all the times that we had lows touching this level and bouncing off of this level. Look, so this is how crucial this price was back in previous trading, and we were able to extend it forward. And what we got here is when price touched this level here, we would have shorted it, and now the price is moving down. We've combined this with Fibonacci levels here, and as price is moving down, 38.2 is a significant Fibonacci level, and price stopped at that level and eventually bounced off of that level. Okay, so these are all combined support and resistance level. It's not very complicated. It's not very easy. It's not very difficult. All you have to do is define these levels. So you define it with eyeballing, and here you define it with Fibonacci levels, and you're using them in a combination for making trading decisions. Okay, now, the more times a price bounces off of support and falls back to the resistance, the stronger these support and resistance levels become. It creates almost a self-fulfilling fantasy. The more these historical patterns repeat themselves, the more traders know. So there's a lot of support and resistance levels that are just known. You'll be reading an article in Market Watch, CNN, Bloomberg, and they'll say, well, gold is moving up and we're expecting gold up to move up to the next resistance level at 112.97. This is a known level. Okay. These levels are not necessarily secret. By using eyeballing, okay, you're getting your own price points. You're getting your own historical look at what you expect price to do at certain levels. But the ones that are well known, especially ones that end in 0, 0, 10s, 50s, 25s, become entrenched into the marketplace. And buyers and sellers will use these as stop loss, take profit points, or when you want to open a trade and you tell the system to open a trade, you're setting a limit order, not a market order, and you tell it, when the euro gets to 121, you didn't say when it gets to 121.42.5, you say at 121.5, open a buy position. So understanding the concept of support and resistance, trading ranges, breakouts can be quite valuable to all traders. Support and resistance is one of the strongest and most dependable tools available to traders. Remember that it is best to use any tool along with other indicators when deciding whether or when to take and exit a position. Support and resistance analysis is an important part of trends because it can be used to make trading decisions and identify when a trend is reversing. For example, if a trader identifies an important level of resistance that has been tested several times but never broken, he or she may decide to take profit as the share price or the asset price moves towards that point, because it's unlikely that it will move above past that level because it hasn't been able to achieve it. Then, of course, I mentioned just a second ago, psych levels. These are whole number levels. You know, the markets just tend to move. Okay, at the 50s, at 00, at 120, these are numbers that you can just kind of know. The euro, when the pound was trading to 160s, 162, 64, you can say 164.00 was an important level, not 164.0017, because traders don't think in that way. But you see, as price moves up and it moves through one resistance level and moves to the next and the next, you also will see this in volume. Because if price is most likely going to break above that resistance level as it's moving up, you'll see an increase in volume, because that's going to tell you the traders are going to continue pushing that price through the resistance level. When it's moving up and it's coming to the next resistance and you see buying volume falling off, it's going to have, it's at least going to stop at that level. So we talked about pivot points and how to get them. Now there's other things like GAN fans. GAN fans provide support and resistance levels in a whole different way, but you have to learn GAN fans, and they're a little bit complex. But the thing about it is, the more ways you get support and resistance levels. Trend lines give you support and resistance, because when price is moving up, the trend line supports the up movement, and when trends are moving down, the trend line is the resistance helping it move down. So the more of these support and resistance zones or levels you can indicate, and the more you can box them or combine them together, the more accurate you're going to be. Now, most experienced traders will be able to tell you many stories about how certain price levels tend to prevent traders from pushing the price of an asset in a certain direction. For example, assume that Jim is holding a position in Amazon and that he's expected the value of shares to increase. Let's imagine that Jim notices the price fails to get above $39 several times over the past months, even though it's gotten very close to moving above it. In this case, traders would call the 39 level a resistance level. So as you can see on this chart, there's my chart. Every time price moved up, it bounced back off of it. So we want to verify support and resistance by one, trend channels. Support and resistance often act as decisive trend changers. When an existing trend line meets resistance, be prepared for a dynamic shift. Then verifying support and resistance. If support is violated, that same level will act as future resistance, as the chart illustrates over here to the right. The same horizontal line continues after support is violated, but with a different effect. The more often a trend line is tested or a support and resistance level is tested, the more valid it comes. So this chart shows resistance at 32.50. On 4 separate periods over quite some time, over a several month period, it came to this 32.50 and wasn't able to break above it or below it. So we can see on this chart that here, as price is moving down, it comes to this 32.50 and we have some congestion at 32.50. It eventually breaks below it, but then it moves above it, but only for a second, and falls down below it again. When it moves back up, it hits that 32.50 and it's unable to break it, falls back down. So at this point, we know 32.50 is a fairly significant level. So at this point, when it hits that level and isn't able to break through it, we might want to short that asset. Hold on a second. Now, the most important of this is volume reinforces. If a resistance or support level is associated with increased volume, the trend becomes more valid. Since 2008, on this chart, 42.50 has served as resistance. Each time that the price level is tested, volume increases. This pattern adds weight to that 42.50 level. It indicates that overcoming that price point will take significant time. And then time matters. The more recently a level has been established, the more useful it is. The problem with current bear market is that quick losses had many traders looking well into the past for support levels. Unfortunately, grasping distant history is not useful. Examining a 3-year graph, we see a valid support at $520 in this chart. But by the time the stocks were collapsing in the fall of 2008, that support level had not been tested for over a year. This made that support level less important. So now if you're trying to trade something like cryptos, like Bitcoin, it becomes a nightmare because it's bouncing all up and down, up and down, up and down all over the place. And there's no historic levels. There's nothing even from 2 weeks ago. Now, when crypto soared to 20,000 and fell back down to 15, moved back up to 60, fell back down to 13. Now, you could find price points in there that were crucially important to the market. Okay, and use these as guidelines, but you're only using very current levels because it's never traded at this price before. So support and resistance levels are just key mile markers in a security's progress. Whenever you're developing trading strategies, consider these points on the graph. Doing so will help you set profit targets and prevent frustration when eventual reversals occur. So as you can see, it's not a difficult concept. It's not even a difficult way to using eyeball to develop these. And once you've done this a few times, you'll be an ace at it. You'll see how easy it is to develop these zones. Now, the thing is, as price moves up and down, you need to keep moving your zones because the zones are only valid when price is in that level. Okay. So support and resistance level. But once you have them on your chart, they stay forever. So if the euro moves up to 122 and you have to create new ones, you keep those lines and you color code your line, because when it falls back down to 121, all those lines you had before for those support and resistance are still valid. So remember, and the more times it functions above and below this, but eyeballing to me is crucially important only because it makes you deal with the asset. It makes you deal with the charts, and you've come up with the exact numbers. Not pivot points, which are just exact calculations. You have no tie to that number. You're just putting on a chart. And you'll find that you'll be able to define these levels a lot easier than you think. Because charting and drawing basics like trend lines, support and resistance, and reading volume should be crucial to no matter how you're trading. Whether you're trading from fundamental analysis, whether you're trading from some kind of cockeyed thing out there, whatever you're trading, whether you're trading from some robotic trading and some auto trading stuff, and it's giving you signals, you should be able to look at support and resistance, trend lines, and volume and know that that will be a good trade or a bad trade. So on that note, I'm going to say goodnight to everybody. Thank you very much for joining us, and I hope I gave you something to think about. And if you go to www.tradetime.com, they have a huge amount of education facilities for you, and they have all kinds of videos that explain exactly how to find support and resistance using eyeballing. They have another video on how to use swing highs and swing lows. They have another one on how to use Fibonacci levels, and they'll explain them to you in detail. So thank you very much. Have a great week, and thank you for supporting Trade Time and Investing.com. Good night now.